All right, guys, how's everyone doing? Paul 6 here with the group mentorship session. I know it says Kanal here, but it's really me. Don't worry. How's everyone doing? Let me know if you can hear me, see me, and most importantly, see the screen. Hey, Robert, what's going on? Ken, Oshan, what's going on? Lyle, Juari, let's see if I have your name right. Claudio, Nick, Dave, uh, Jahan Saib, I think I've got your name right. I know I always mess it up. Davey, Matthew, KP. Wow, good, really good turnout today. I'm glad. I was a little worried. We had the rescheduling problem yesterday, and then I wasn't sure if the Friday 1 o'clock time would work, but it looks like we've got a good turnout, so that's awesome. Michael Pregnesh, how's it going? We'll wait a couple of minutes to make sure everyone gets in here. Um, Hope everyone's been trading okay. I know it's been a really interesting, crazy, insane market to trade right now. A market that's not very common, because these kind of markets only happen maybe on average once or twice every couple of years. Skip, what's going on? Skip is a long, long time member. If I'm right, Skip, I think you've been here since we started in 2014. One of the real OGs here with Skip. Mike, I think I already said KP. All right, KP, new member. That's awesome. Let's see where you guys from. Reno, Mike. So let me know where you guys are from. And while we're waiting, whenever I do one of these types of things, I always like to do book reviews. Let me see if you guys can see it here. This is what I'm reading right now, Big Debt Crisis by Ray Dalio. This is really interesting, and it could be pertinent right now. So basically, if you know anything about Ray Dalio, and if you follow me on any social media, you know I bring his name up all the time. I'm a huge fan of his, one of the greatest hedge fund managers of all time. Has a really interesting way of looking at things. Um, and he's compared some of the big recessions, depressions, really big market pullbacks going back years, I think maybe to the 1800s, but he compares 1930s, 1970s, 2000s, 1980s, and some of the common things that are occurring before we get these big meltdowns. And he sees one coming up, and I think a lot of us see the same thing. So if you get a chance to, I ordered the book. He thinks this is so important, even though he has a book. He actually makes the PDF free online. So go ahead and take a look at that. Let's see where you guys are from. Whoa, Ivan, Fresno. I'm from Fresno. I was just in Fresno over Thanksgiving. My parents are there. That's awesome. Pennsylvania, Florida, Canada, Delaware, Ohio, Sacramento. I was in Sacramento not too long ago. Houston, Las Vegas. I'm always in Las Vegas. Uh, that was Robert. All right, guys. We're about 6 minutes in. So why don't we go ahead and get started? The way this is going to work is, as usual, with all the webinars and or all the group mentorship sessions. And the way these work is I always start these with something I want to talk about, something that I think is educational for you guys. So it starts off with that, and we're building a library of these. So you guys know in the report every morning, there is a link to the report video, and then I have the link to past mentorship sessions. If I'm right, this is like the 8th or 9th one now. This is a new thing we've started, kind of a benefit for you guys, which I try to do these twice every month. Okay, wow, a couple of people from Washington, Germany, Europe, New Jersey, Portugal. Wow, we're from all over here. This is awesome. Um, okay, yeah. So what was I saying? Oh yeah, yeah. Okay, so we've built a library of these. So what we're doing is we're treating it as a mentorship, group mentorship, where you can ask me a Q&A, and I'll really dig into what's on your guys' minds and what can help you. But before we even do that, we get into some topic, and we're building a library of these topics. So you can go in now. There's 8 or 9 of them, I think, and you can go in, and I'll label them better as we go through these now, what each topic is. And you're going to get a library of these topics and I think we delve into things a little different than most people do. So you're going to have some really good information in here. All right, so today what we're going to do is we're going to talk about corrective markets and this way to trade them. We did a stat review last time and talked about how we were going through the process. And now we're deeper into this and the market is changing a little bit. And really quick, guys, you guys can see my screen right now. So what you should see, let me know. You should see the outline here, rough outline, and then my charts behind it when I click over. So if you can see that, let me know. Yeah, okay, good, good. Okay, so this time we're going to talk about like how we've traded through this and kind of dig into what the mindset has been through here as we go through the statistics. And the statistics are going to help you see how a professional trader should be trading through this market. So let's hit the statistics and we'll talk about what we need to talk about as we go through. 13 trades. So one of the points here, and I did put this in here in terms of trading frequency, is during these types of markets, you should be trading less, not more. And that is opposite of what most people are doing. See, what happens is this volatility starts to come in, and a lot of traders, they think, wow, the market is just super volatile. We're getting these crazy, insane moves. I should be trading all the time. And that's really the opposite of what you should be doing. If you're doing that, you're probably getting crushed. So that's why most people, and I've talked to a lot of traders, some of you, but most of you have been listening to me every morning and aren't making a lot of these mistakes. Some of you I know have kind of veered off on your own, and you have. But a lot of traders that I talk to, they've been having issues during this period. And what often happens is you lose way more during these periods than you do when you gain through this period. And I'm seeing that a lot where, maybe, traders wrote a nice 5-10% during this period, but now they've lost 20 or 30% on this meltdown. And really, at worst, you should be break even on the year. So trade less frequently. One of the biggest mistakes traders are making is they're just trading too much. What you have to do is you have to sit back, and you guys know, you listen to me every day. We're really patient. Sometimes we might even miss a move. That's okay. If you're in cash, you're beating almost everybody. Even the pros, the hedge funds are getting crushed. So be proud of yourself. If you're break even or you're making money, which we've done during this period, you and we're crushing everyone else. And forget about what you hear about on Twitter and all that. You're beating just about everybody. Through this period, the market is down 8 to 10%, and most people are down that much or worse, usually worse. So if you're only down 2%, you're actually doing very well. And break even, you're crushing it. Making money, you're doing even better. So trade less frequently, and that's what we've done. If you look here, my average this year has been 10 trades per month. During this corrective phase, it has been 7 trades. I know 3 trade difference doesn't sound like a lot, but it is. It's the difference between making about 120 swing trades a year and a difference of, I think that's 87 times 12. Is that 84? If I'm right. My, my basic math is off, guys. You can correct me. But somewhere around 84 trades here. So that's a huge difference. That's almost that's a difference of 35, 36 trades in a year, and that's a huge difference. And I actually probably have been a little more aggressive than I need to be even. So one, your trading frequency needs to go down. So let's go over some of the statistics here. So what I'm measuring is basically our trades, and we are up 28.4% on the year, and that's not including the unrealized gains in the 3 positions we're in right now. Otherwise, that would be around 30%. But we're up 28.4% on the year. To give you some perspective, the market is up about 2% on the year. So we are crushing the market and crushing just about everyone. So that's really good. But going back to October, so we're basically taking our stats around this when the meltdown began. And you guys remember, we actually held up very well during this period. We knew up here something was wrong in the market when everyone else was saying, okay, we're at all-time highs, we're breaking out, get super aggressive. We understood what was happening with market breadth. And we got out of the market. And I know when that was happening, I got criticized by some people. I would get some emails. Hey, why aren't you in the market? Hey, I'm in a trading service. I expect trades and the market's at all-time highs. And I didn't let that impact me. I understood what was going on. We understood what was going on in the market. All that market breadth stuff you hear me talking about in the morning, T2108, IWM compared to SPY, our watch list, new highs, breakouts, all of these things were telling us something was wrong, and then boom. So when this happened, we were only in one position. So it made it very good. You know, that's one way we protected ourselves. We didn't take the initial losses that a lot of people did. So October here, we're starting with the statistics here. Actually, I think my statistics are off because I actually did not include. Oh no, I did. Okay, we start with TQQ here. So this minus 750. So starting from there, we made 13 trades, 5 wins, 6 losses, 1 break even. So if you didn't know anything else and you just saw this, you'd say, not so great. Maybe you're down a little bit. You only have 5 wins and you have 6 losses. Uh, we do not care about the win rate, especially in these volatile markets. You don't make money off your win rate. You make money off your wins versus your losses, the size of your wins versus the size of your losses. That's what you have to focus on as a swing trader. And actually, when I have this is going to sound counterintuitive to some of you, but when I have a really high win rate, like say I've been trading for 6 months and my win rate's around 80%, while you might get happy about that, I actually get a little concerned, like why is my win rate so high? Because what that is telling me is maybe just taking really quick profits and I'm just getting those wins, and I just really get really quick wins, and it's very easy to get a high win rate that way. But I'm probably not getting the rewards that I need to be getting. So we're trying to get the bigger wins. So I don't care about this: 5 wins, 6 losses, 1 break even out of 13 trades. Now, this is what I care about right here: average win versus average loss. So the average win has been 2287, $2,287. The average loss has been $944, and that's reflected here. Let's take a look at all our losses here. I've got minus 750, minus 800, minus 980, minus 650, minus 1200, 1073, and 1142. All within the risk parameters we've been trading, around 0.7% to 1%. This one got a little high here, Netflix at 1.2%. Well, actually, I'm going off of 100K, but it's actually less than that because the account has grown. But I still think of it as 100. I don't go off 130. So small wins, exactly what we want. We have not taken any big losses, and that's a big correction we made from earlier in the year when I had some of these, almost 2,000 loss here, 2,500 here. 1,700 here. If you remember in the webinar, we talked about this point. At this point, we were going to correct this. We weren't going to let that happen again. And this is a market where things can get away from you. And I'm more than anything really happy with myself in the regard that my losses have been small. There's some other things, maybe I beat myself on that I could have done and got even bigger wins. But this I'm really happy about. Keeping the losses really small. Now look at some of these wins. 1,500, that's fine. This is the break even, the $18. We could technically call that a win, but that's anything, minus 100 or plus 100, I basically consider a break even. Now here we go: 3,800, 3,000, 2,000. These were our big wins. This win right here basically covers all 4 of these losses, and this is just gravy then, right here, these 2 big wins. So that's what we want to get, especially in these volatile markets. You need to hit the big wins. You take your little shots, and some of them are going to be losses because you don't know when some of this stuff is going to happen. We're in kind of 3 shots right now. So you just take your little shots, and you're going to lose on a lot of them. But you're, being very calculated in the setups you're trading. You're waiting for those right moments where maybe it's not the highest probability trade. Maybe the win rate on this setup you're trading is not 65, 70%. Maybe it's only 40%. But if you hit you're going to hit big. And that's what happened with these shorts we took. We knew if those shorts, if the market continued down, we were going to get big wins, especially in the leveraged ETFs. We've known in these losses, they're going to be small losses if we take them on our longs. The longs that I've taken, I know if I hit, they're going to be big wins. You know, the LABU, the Lulu, and the Netflix Now. We talked about this in the report. If I hit these things, or if we hit these things, we're going to get 3.5, 4 to 1 on these. They're not just going to be 1.5 or 2 to 1 trades. So I'm willing to take these little small losses to get these bigger wins. And that's been the idea in our trading here. Trade infrequently, look for these very high reward, low risk spots where the market is aligning nicely for you. And if you lose, big deal. But when you hit, you're going to hit big. So total gain this period has been around $5,000 or 5%. And that is actually, you know, in a normal market, I would say, ho hum, that's fine, whatever, you know, probably could be doing better. But in this market, that's actually really good. So again, let's skip over to alpha here. SPY during this corrective phase down, and this was to November 27th, and it's actually gone a little bit, so maybe that's down 7% now. But when I did this, and as of the trades, down minus 8.3%, and it actually had gone down even farther than that, about 11% from the highs. So while the market is down 8%, we are up 4.8%. That is crushing the market when the market is down like that. And again, remember, most people, even the pros, are losing during this period, and we are winning. So pat yourselves on the back if you're winning. If you're just beating minus 8.3, pat yourself on the back, because most people are losing bigger than the market. And then there's a group, I would, if I was gonna, these are rough percentages, I would say 60 to 70% of people are losing more than what the market is doing right now. Then maybe 20% are kind of just barely beating the market. Then there's even a smaller percentage that are really beating the market. And that's where we're at right now. So our alpha here is plus 13% in terms of how much we are beating the market. And I know it sounds like I'm bragging, and I usually don't brag, but I'm not bragging. The point is, the way we've analyzed the market and the way we've been trading is the way you need to trade during these types of periods. And this is all gravy. I'd be happy to even be down 2% during this period. So analysis has been on point. These high risk, never high risk, low risk, high reward setups we've been trading. This is the way you need to be trading. Okay, so another point here. All of our profits have been from the short setups, and I got some questions about this. And you know, a couple of points on this. If you look at the statistics here, leading up to this time, now we've taken a lot of shorts, and these inverse ETFs, you guys know, we're actually going long the ETFs to short the market because they're inverse. But I consider those shorts, so I put an LS here. Just go by the S here. But you know, most of the year we've been long. I would say, I haven't done the count on this, but I would say 85% of the trades, there have been 103 trades at this point. Actually, right around 100 trades. My guess is 85% of them have been longs. And a question I get, especially from a lot of new members, is, hey, are you a perma bull? Are you bullish always? Do you only take longs? That couldn't be further from the truth. I love to short. You guys have seen it here. I do like to short, but I go by what the market is telling me, and the path of least resistance for the last 2 years has been to the long side. Why would I be shorting in a booming uptrending market? It doesn't make sense. Now, we have picked our spots to short, and I think, if I'm right, here's one loss. I think there's only one loss, one break even, and every other short this year has worked. So we've actually traded the shorts really successfully when we've taken them. And now, you know, we've taken obviously a lot more. I think about 50% of the trades right now have been shorts, going into, not counting the last 3. So all of the wins during this period have been shorts. And the question I got was from a few of you is, hey, if the shorts are working, why are we going long? Why do we even take any of those longs? And obviously you can see here, I've taken some long shots. I took the shots here, here, here. The reason we still take long shots are one, to hedge. Um, in these markets, we can get strong bounces, and you never want to get caught too far to the short side because you'll get crushed, even though it's a bear market. Bounces, you can see this 2-3 day bounce here was one of the biggest bounces of the year, even though it's in a corrective market. Same goes for this bounce here. This bounce was more powerful than the bounces in the uptrend. And then we're getting another one right now. So you don't want to get caught too heavily in one direction, or it just wipes out your gains. So you can use some longs as a hedge. And also, the risk reward on these longs is fantastic. You only need to risk a little bit. You're seeing this now with, potentially with the 3 trades we're in. If you lose your, 0.7, 1%. But if you win, you can get 3R or 4R on these. So I'm willing to take these little shots, knowing that if they hit, again, they're going to hit big. So we still take these longs, even if we are in the bearish market. Okay, so that's the reason we're going long. I was going to review some of these trades. I don't know if that's going to be as valuable as actually getting to the mentorship portion, because we've gone through these trades um, in the report. I think what I'll do is we'll do another group mentorship session where I'll actually break down all the trades we've taken. If you have any questions about any of the trades we've taken, let me know. But let me just point out a few things. You can see here with SPY. Well, let me actually pull up SPY instead of SPXL. Where did we pick our spots to short? The shorts work best on failed bounces. So you don't want to start shorting when the market is already getting crushed. It's usually too late to short at that point. What I like to do in these bear markets or corrective markets is wait for a good risk reward spot, wait for a potential bounce to happen, and watch that bounce fail, and then we get in. So, some people will call these dead cat bounces. You've heard me mention that in the reports, dead cat bounce. Here was that first spot. This is where we got into SQQQ and SPXS, the index shorts here. We shorted right in here. Now you can see clearly, it's interesting now to see how perfect it was. But back here when this was happening, I actually got questioned about it. Why are we shorting here when the market seems to be bouncing back? It wasn't bouncing back. We still had poor market breadth. So we knew that was a good spot to short. So we shorted in here. The next time we shorted was when the market was bouncing here and we got that failure. And then we shorted right in here, another good spot. Both of these, the market was still weak. Underlying market was still weak. We talked about it in the report. And fantastic spots to short. Now, an interesting development has happened. The market breadth has improved. We've been talking about this in the report, that we're seeing better underlying indicators. One is the T2108. Let me pull that up for you guys. Stocks above their 40-day moving averages. Stocks above their 40-day moving averages, very strong. I want to point to one thing here. Look at where this peak went to, and now look how SPY is below that peak. We had this peak up here in early November. Now SPY is below that level. Qs, same thing, below that level. Now look at T2108. T2108. T2108 again, stocks above their 40-day moving averages. T2108 is above that level. T2108 should be down here if it was doing what the market is doing. But what is T2108 doing? It's up here. This is a positive divergence. The fact that more and more stocks are above their 40-day moving averages and putting in a better chart than what SPY is telling us underlying the market there is strength. So that's one of the many good indicators. The earnings season is getting better, whereas in the beginning of earnings season, even when stocks had good earnings, they were falling. Netflix is a great example. I talked about this when we got into Netflix just now. Netflix is a great stock. Broke out here on fantastic subscriber growth, fantastic revenues. earnings and guidance, and it broke out. It should have continued, but it went down. That was a concern. Something's wrong with the market when you see stocks like that. And we were seeing that over and over again during earnings season. But now we're actually seeing a lot of good, strong reactions to earnings. So another good market breadth indicator. My own focus list, seeing more and more good stocks to trade. So all of these things are good for the underlying market, which is why now I've gone from slightly bullish to market neutral. And if we cross these moving averages, we'll get even more aggressive to the long side. But if it fails, we will short again, much like we did here, much like we did here. So bounce failure, probably if it got below the 9 here around 270, means we start shorting. Okay, all right. So that catches up here with what I want to talk about, what we've done during this corrective phase. If you have any questions about it, ask me in the Q&A. Okay, our alpha, again, minus 8.3 in the market. We are up almost 5%, alpha of 13%. Year to date, we talked about that same thing. Market down 1%. That when I did this, market was down 1%. Now I think it's up around 2%, but doesn't change much. We're up around 28%, alpha 29%. So basically crushing the market. Couple of areas I want you guys to pay attention to. I've already talked about this in the report, and I'm going to continue to talk about it, but pay attention to relative strength. That's the most important thing right now. If the market is improving and we're going to skyrocket from here, if we're going to break these ranges here and then run up to highs, we're going to take a couple of shots with stocks that are beaten down, like something like Nvidia. But our main focus is going to be stocks showing relative strength. What has held up in this market? So you guys know we've mentioned Ulta already has been very strong. If you saw this chart, you wouldn't even know that the market has been in this big corrective phase. Orly, we know, has been fantastic. The BRIC countries, so we've been mentioning these, INDL. Look at how strong it's been in here. India. We know about Brazil, ever since the elections in Brazil. Huge move, crushing the market. And then China is improving as well. I would hold off on China a little bit with these trade talks that are going on. But pay attention to the BRIC countries, Brazil, Russia, India, China, and then strong earnings breakout stocks as well. Let me go through some earnings break. These are some stocks that broke out on earnings this quarter. And look for the ones that are showing strength. Look at AYX. Software is also a good sector. AYX, near highs. This is relative strength. Cyber, near highs. This is relative strength. Under Armour, near recent highs. This is relative strength. So build Crocs, relative strength. So build your Twilio, one of my favorites here, relative strength. So build your list of relative strength stocks. If we start to add, this is what we're going to add from. Take a few shots with some beaten down stocks, but really focus on the relative strength. So that's what we're going forward. It's BRIC countries, it's relative strength stocks, especially earnings related relative strength stocks. And then be prepared, be adaptive. Plan A, plan B. Always have a plan B. Plan A is the market continues up. We go to our relative strength. Plan B is the market fails here. And all we really need to do at that point is index shorts. Okay, guys, so that's what I wanted to talk about today. If you have any questions related to this, go ahead and ask me. And then open question and answer right now. Whatever you guys want to talk about. This is really the mentoring portion here where I can help you guys out. Can you get the spreadsheet? No, I don't release this spreadsheet publicly anymore. A couple of reasons for that. One of the biggest reasons is people don't understand what we're doing here. And anytime I take some losses, I just get crushed. And I just get emails that frustrate me. So I don't like to have this out publicly. So even in a year where we're crushing the market, I take 1 or 2 losses and I just get a barrage, just a ton of emails coming in. So I don't release this publicly, but you can see here, and what I'll do here is I'll keep it here now, and you can look at all these. You can have it on your screen, take screenshots of it. That's fine. So I don't care if you guys have it. So just take a look, screenshot it here, then I'll scroll down and you can take some more screenshots. And then sometimes I get a question if if you can get a template of this. It's very easy to set up, but if you need a template, I mean, this is a very basic spreadsheet, but if you need a template, go ahead and email me, singjd1@aol.com. I know I get crushed for having an old AOL account. This is the account I've had since the late 90s. I do have a Gmail account, but I like to use this. So that's sing, S-I-N-G-H, J as in John, D as in dog, 1 at AOL.com if you want the template, and I'll send you the template. Again, I'll wait a little bit and I'll scroll down. You guys can take some more screenshots. Okay, buying power, good question, Metin. Buying power, I do go on margin. So it's not, wherever I am, double in terms of what we can do with margin. But when I go on margin, my risk parameters stay the same. This is a mistake people make when they trade on margin. You might hear people talking about, hey, never trade on margin. It's too risky. It's not risky if you know what you're doing. So for example, let's say you have a $10,000 account and you're risking $100 per trade. When you go on margin, you can go up to 20,000, but your risk shouldn't go up to 200 because you only have 10 in there. So your risk should stay at 100,000. What it's helping you do is just take more positions. Okay. Is it possible to learn something about your setups? If you sent a new entry, I'm a little confused, Metin, because every trade I take, I talk about. I give a little in the alert. It's more of an alert. I need to get that out to you as quick as I can. Sometimes the price changes and I don't want the price to change. But when we talk about it in the report, I go over the trade. So I'm a little confused about what you don't understand there. Okay. Abe, you were late. All right, you're gonna get a tardy there. No, that's okay. There'll be a video recording of this. Don't worry about it. Anthony, how do you know when to let your winners go past the target? Good question. You've probably seen this a few times where we've had a target set and I don't take the profit at the target. I go for even a bigger win. So what causes me to do that? There is no one blanket answer for that. There are many factors that can lead me to go for a bigger win. Usually it's related to the market and the sector. So if we hit our target level, but I'm noticing that, wow, this market is really good. I think the market's going to run higher. I think the sector is really strong. At that point, I will let it go. So there needs to be something else, not just the stock. Basically, anything that kind of puts the winds at our back, and I think we can get a bigger win, I'll let it ride higher then at that point. Are you worried, Claudio? Are you worried all the longs you're taking will go down next week? That could happen, but that's why we manage our risk. So let's say I lose on these 3 positions. I think the risk on all of these is like 0.8%, if I'm right. Maybe somewhere a little higher, but let's say they're 0.8. That's 800, 800, 800. That would be, if I lost 3 of these trades, that would be $2,400. That would be 2.4%. Big deal. So you see what I'm saying? These losses shouldn't bother you. Yeah, I definitely could lose on these, and I would take 3 losses. But what happens? I lose 2.4%. That's not a big deal. So I would be concerned if I was taking huge risk on these, like 1.5, 1.5, 1.5. Now all of a sudden I'm risking 4.5, almost 5%. Then I would be a little more concerned. And you have to have that mindset. Too many of you guys, you're living and dying by every single trade. That's not the way. You can't trade like that. You have to be thinking big picture, longer term. You get a loss, you don't care. You get a couple of losses, you don't care. If a loss is upsetting you, that probably means you're trading too big. Okay. Ivan, can you explain market breadth in detail? Okay. I think I've explained it in the reports every day in what we just went over. Market breadth is kind of the underlying mechanics of what's going on in the market. These indexes don't tell you everything. For example, when I'm looking at SPY here, Um, this is just telling me what the index is doing. I don't know what the broader market is doing, what all of the stocks that make up SPY, that make up the market are doing. So market breadth is basically trying to figure that out. And what I just talked about, the T2108, uh, the differences between the indexes, looking at the stocks within the indexes, how are stocks breaking out? Are we seeing strong setups? That all relates to market breadth. All right, Tesla. Yeah, Tesla goes on and off my watch list. I'm actually really, it's one of these stocks that I'm really nervous to trade just because anything can happen after hours that, sends the stock tumbling up or down. But I would say right now it's very strong. It is definitely relative strength. I mean, all you need to do is see the fact that um, SPY is below these moving averages and Tesla is above these moving averages. So right there, you're seeing relative strength. So definitely a strong stock right now. Are you always using so extended till 2000s? I don't understand your question, Nick. Could you rephrase that? Eric, I'm new to leveraged ETFs. How do leveraged ETFs decay? What happens if you hold for several months? Great question, Eric. And you don't really need to know the why. You just need to know that it happens. You do if you're going to be holding one of these. Good point there. If you're going to hold these leverage ETFs, so let's take Qs. So leverage ETFs we trade 3 times leverage are TQQQ, and notice that Qs were up 0.7%, TQQ was up 2%. So these are going to be up much higher than the underlying itself. And SQQ should have been down around 2% today, and it was 2.3%. So this is the inverse. So what happens is there's an open and a close, right? So when there's a way that these things are calculated, because the futures are continuous. There is no open and close. They just go 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 until Saturday, and then they open again Sunday. So, but with the ETFs that are trading off these things, there's an open and a close. So when that's calculated every day, there's a little decay. And the decay is more pronounced on these leveraged ETFs because there's 3 times. So, um, short term, it's no big deal. It's insignificant to us, the little decay. If we're holding for a couple of weeks, totally fine. But if you're thinking more long term in terms of long term swings, you can't trade the leverage ETFs. I would say probably if you're going to hold a position for more than 3 months, don't use the leveraged ETF. You can just see here, you can do a comparison of where SPY is and where TQQ is, and over the long haul, it doesn't keep up 3 times the numbers like it should. So just know the why doesn't matter. Just know that it happens, and if you're going to be holding it longer term, don't use the leverage ETF. All right, Nick, what do you think about Microsoft? Microsoft's been making a comeback, and look at that. Um, Much stronger than the FANG stocks. I mean, compare it to Facebook, compare it to Amazon, doing very well. It's above all of its major moving averages. So should be on your relative strength list. And I would say if you're looking for something to enter, you could be in it right now. So yeah, Microsoft, very strong. I don't tend to trade it because it's just not, this is a volatility number 27. Most of the stocks I trade are going to have a higher number than 27. But definitely a good stock. Vineet, yeah, just email me and I'll get you the template for the spreadsheet. How do you determine the RS of an individual stock? Good question, Mike. There are a number of ways to do this. So let's just take Microsoft for an example. We just talked about this. The fact that Microsoft is above its major moving averages and SPY is not tells you right there it's a relative strength stock. So right now you could do a scan for stocks above their 50-day moving averages. Every one of those is going to be a relative strength stock. The other thing you can do is take a time period. Scan going back to October, or scan more recently off this low, or scan from here. Wherever you scan from, The stocks that have the highest percentage gains during that period are beating the market. Compare them to what the market has done during that period. Those are relative strength stocks. Netflix is up about 5 points from where we bought it. Would you consider moving the stop up? Good question, Harry. Um, I do at some point move the stop up. I'm hesitant to do it now because what you don't want to happen is move the stop up. Like, okay, let's say you enter here, your stop is here, and then the stock goes up to here, but it's still within its natural volatility range. And if you move it up, you're just going to get chopped out of what is a good trade. So the market could still, the stock could still go down 7 or 8 points, and it's still a good setup, and I don't want to be chopped out. But there comes a point where I will. So if my target is here around 320, and you guys have seen me do this a number of times this year, where I've moved the stop up to break even, and we took break even trades. If let's say my target here is 330, and we get up to 312. At that point, we're outside in the natural volatility getting of that level, and if it got to that level, it's probably failing. Then I would move my stop up to break even, but not at this point. Okay. I took a shot at Twilio when it hit our original entry. Do you think this will break 100? Also took a shot at BRZU. I like both stocks. So yeah, if you're in those stocks, Skip, I think they're really good stocks. What constitutes a failure when the market bounces? That's specific to each spot, but let's just go over these. When we bounced here, the failure was the fact that it couldn't get past this resistance level and started to fail. And once we started seeing that, that was the bounce failure. Same thing here. Now you could have been more aggressive and took it right when it started pulling back, but I think we waited to make sure it broke the support level. So support levels or failure at resistance levels will indicate failure. So for me here, currently, what's pertinent to us right now, if the market goes, if the market were to break out above these moving averages and come back down, that would be a failure, come back to here. Right now, if we got below the 9 EMA, which is at 271.48, that would be a failure. Is it possible to get an alert when the swing report releases? You get an email. It gets sent to your email. So that's the alert. How do you know relative strength ones will perform better than beaten down ones in a bounce? Experience. I've been through many of these. Now, initially, good question, Karsten. I'm hoping I'm saying your name right. Initially, sometimes the beaten down stocks will bounce stronger. But if the market is truly going to trend, the relative strength stocks will lead the market. So I fully expect if the market trends higher now, that software, that brick, and all these earnings breakout stocks are going to lead the market. That doesn't mean NVIDIA couldn't make a great bounce, but I tend to go towards the relative strength more. This is a really good question, Salim. When you get emails that you are not trading much, does this pressurize you? And if so, what do you do to be mentally strong? My issue is taking too many trades in my aggressive account. Thank you. Okay, really great question. So the point here is kind of the mindset. We're trading to make money. I know this, and I've been through all this. I've been trading for many years. I know how frustrating it is to sit there and do nothing. And I know you guys hear me. The comment I get a lot is whether you've taken a win or whether you've taken a loss, or no matter what the market is doing, you sound the same every day. And you need to get in that mindset. I've been through a lot of these, many rodeos here, and I know the way I should be trading. So that helps me stay on point and know, I can't be trading. But there is this urge that we feel like I have to make money every single day. And if I'm not in a trade, I'm not making money. But as a swing trader, and this is a little different than day trading, because day trading, you always have a potential trade sitting there. With swing trading, the best swing traders, they know, you hear me say this all the time, they know when to put on the brakes and step back, because the market has to give you these opportunities. So you have to know when to step back and wait, and then when to pounce and step on the gas when the opportunities arise. And you've seen that through this period here, where up until recently there was a period where I think for a week and a half we didn't, or 2 weeks, we weren't even in a position, and it gets frustrating. And when you're running a service like this and everyone wants trades, it is tough to just say, hey, we're not making trades. But trust me, when I do that, it's saving you by not making these trades. And you've seen it during this period, where if you've been trading less frequently, you're doing much better. So yeah, you do have to have that mindset. You have to understand what you're doing is the correct play, that it's not about just making a trade every single day. You have to let your account sit there sometimes. All right, I think Ahmed, I already did the Tesla. Will you hold through earnings? I will not hold through earnings for Lulu. So with Lulu, it's a fantastic setup, really good risk reward. We're playing a run to earnings, which are going to be late next week, 12.5 or 12.6. And I will definitely be out of the stock before earnings. Alpha KP is the amount you're beating the market by. So if the market is up, if the market is up down 5% and you're up 15%, your alpha is 20. If the market is up 5% and you're up 15%, your alpha is 10. Do you trade breakouts or retracements better from PA? Come on, PA, I trade everything good. But no, it really depends on the market. I don't care. I trade them. I trade them all. I trade them all the way I should be trading them. But if you're asking like which setup is better, it really depends on the market. So if it's a good breakout market, I will be trading those better. If it's a good retracement pullback market, I'll be trading those better. So you have to be, your approach to these setups have to be adaptive to what the market is doing. How do you know when to add a position? Matthew, you probably noticed I don't usually add to my positions. I take the position I want. Now, what I'll do is, like, let's say with Lulu here, and let's pretend earnings weren't coming up, okay? So if Lulu ran to the 50-day moving average, the next spot to enter would be above this level if it broke that level. But what I would do is I wouldn't add here. What I would do is I've taken the position size I want. I'm going to get out below this resistance level. And then if that level breaks, I will get back in with the position size I want. So I always just take the position size I want. I very rarely add. I did a statistical analysis a few years ago. Some of you have heard me talk about this. And I did two things. I used to add and I used to do partials. I used to do a lot of it. And when I broke down thousands of trades, what I found was adding to positions and taking partials were not giving me an edge. I would have made more if I just stuck with the positions I was taking. And so because of that analysis, that's the way I trade. All right, Ken, new guy question. As trades go well into the green, do you put a mental stop or break even? I think I already answered this. So Ken, your question was answered about moving your stops up. Would you consider Apple a broken stock? For now, yeah, but that doesn't mean I won't trade it. If it gets up over the 9, we could get a rubber band bounce play. So we have trades for broken down stocks, and one of them is rubber band bounces. Stocks that are beaten down often will give us a nice bounce play. Apple goes through these. All of these FANG stocks go through these every once in a while. If you go through the history of Apple, you've seen some of these declines. So even in strong stocks, this happens. So do I think it's broken long term, Kishan? I really couldn't tell you, but there are definitely setups to play for it. And obviously, if it remounts these moving averages, it'll be back on trend. Okay, do you scale out when riding higher? Ivan, I've already answered that question. Okay, Metin, I see your alerts. I don't know if you're going long or short. Okay, so when you get an alert, if I don't say anything, when I say I've entered, that's long. If I say short, that means I'm shorting. I love your top to bottom market approach. It's from Claudio. Would love to see more on how you do this. Interestingly, I'm teaching some of you, I know a lot of you have been through the boot camp. Also, when I mentor people individually, I go over this a lot. But next week in the boot camp, I'll be teaching 3 guest sessions, and one of them is sector analysis and the top to bottom approach. I don't have time to do that here. Maybe in a future mentoring session, we'll go over it some. But Metin, I think you're new. Those of you who've been with me for a while and you see what I'm doing every day, you pick this stuff up. And that's the way I treat the report. It's not a class, but honestly, I know I've been patting my back a lot in this mentoring group, but I really think these reports are the best way to learn. Because you see how we're trading on a daily basis, and you kind of organically pick all this stuff up. Skip, I know, who's been with me for a long time, he knows exactly how I trade, and he's picked up all of this stuff just by listening to me every day. So if you've been listening to me for a couple of months, you've started to pick all this stuff up, and you have a really deeper understanding of how we're doing a lot of this top to bottom stuff. Okay. Do you use any other sources to find stocks, magazines, IBD? No, I don't do any of that. I find that just clutters what I'm doing. I have an approach, and I don't listen to anybody else. I ignore just about everything I hear. So it's all my own analysis. And what I'm doing is running a few basic scans. When people ask me for scans, they're really surprised at how basic it is. Just breakouts, breakdown, overbought, oversold. Every single day, those 4 scans. But the most of where my stocks are coming from are my sector analysis and market analysis. And this whole list here, scans did not spit that out. I don't care about IBD stocks. I don't care about what's on StockTwits. It's just from my analysis. What's the best strategy? This is from Vineet. I didn't exit Netflix and kind of stuck with it. I know your rule. I'm confused. What do you mean? We just got in Netflix, so why would you want to exit it right now? Never adding. Did you add it? Were you in it up here? Vineet, go ahead and add more to what this question, because I'm a little bit confused. What's going on, Dylan? I've worked with Dylan one-on-one. He's asking if we do these monthly. They're for the most part, I try to do 2 a month. What do you think about EDC? Let's pull EDC up. Emerging markets. Yeah, of course, I like the BRIC countries, so I'm gonna like emerging markets. I prefer to trade the country ETFs, but EDC is fine as well. Basically, I like to pick the country I think is going to do better. So, for example, right now, I'm a little hesitant about China, so I would rather not be related to that and go with where I think the better opportunity is. Okay, Metin. Metin has a question about margin, and there's a lot here. Let me see. $10,000 account. So 2 times would be 20,000. Okay, there's a lot there. I think what he's asking is the overall. So what I mentioned is keep your risk in line. By going to 20,000, you're still only risking $100 a trade, but you have to think of your overall account too. Because you're at 20,000, you can take more positions. So, if you take 10 positions risked at 1%, you could be down 10% if they all lose in your same direction. What I would say to that is, 1, try to take non-correlated setups. Ray Dalio talks about this a lot. Remember, I talked about this book here. Ray Dalio is one of my idols here. He talks about in Principles, and this was a big basis of his hedge fund, is taking non-correlated positions. What that means is positions that aren't going to be affected with each other. So for example, we are saying that we like software stocks right now. So if you took Twilio, Team, Payc, Cyber all together right now, that would be 4 stocks in software, risking 1% each. It's really risking 4% because they're probably all going to lose together. So these are correlated positions. What you want to do is balance it out and take non-correlated positions, positions that aren't going to be impacted with each other. So you take one software stock, you take one brick stock, you take one tech stock, you take one metal stock. These stocks aren't correlated with each other, they're non-correlated. So that's one way to balance that risk. The other way is take longs and shorts. So, if you've got 3 longs and you feel like, oh crap, if I lose on these 3 trades, that's going to be 3%. That's too much for me. Add a short, and then you hedge that risk. All right, our resident gold bug, Davey, and I've worked with Davey one-on-one as well. He is a pro at macro analysis and gold. He wants my take at gold, and I think his take is going to be better than mine. I've been a little concerned, Davey, that with as far as the market has pulled back, gold hasn't shot up some. And my theory behind this has been, in the higher interest rate environment, gold is not the flight to safety that it usually is. But now that we had Powell talk, the Fed just said, maybe they're not going to raise rates as much as was initially expected. Maybe that will help gold some. Okay, all right. Wow, we've got a lot more questions here. You guys are really active today, and I have got to get out of here. I got to go pick my daughter up from school. But let's try to hit a few more of these. Is there a reason you don't sell half? I mentioned this, Jimmy. I don't take partials. I rarely take partials. I wouldn't say never, but do you look at money flow? Yes, I do look at money flow, and when I consider money flow, is volume flowing in and out of the stocks and sectors. So volume analysis is basically what I consider money flow. What are you looking at before taking a position in your watch list? Good question, Robert. Top-down approach, market. How's the market doing? How's the sector doing? What setups work with my market and setup and sector analysis? And from there, drilling down to the stocks and looking at a specific setup. So that's the kind of layout of the top-down approach. I'm getting a lot of these questions, Karsten. I recently found out that a lot of our European friends and traders can no longer trade US ETFs. And I'm not a pro on what's going on in Europe and what you can do over there, but they can't trade the ETFs. I know they have CFDs, but even those, I don't know if they can do. Another thing you could do is what I talked about, the non-correlated approach. So if I'm shorting SPY, and you got to kind of do this on your own, but what you could do is pick a group of SPY stocks. So these are the stocks here that make up SPY, and kind of create your own ETF basket and short those. So that's the only way. If you don't have the ETF, that's the only thing I could think of that you could do. Oh yeah, Metin, here we go. Okay, so here's you guys probably got snaps of this up to 42. So let's go, if you want to take snaps from here, here's 45 to 86, take them quick, and then I'll put the rest on so you can take snaps of those. Is there a lesson on position size? We can go over that. So, basically calculate your risk reward and then, multiply the amount you're risking by the price, and that'll give you your position size you can take. Do you also day trade? I do day trade a lot. I don't talk about it here in the swing report because my focus here on Bulls on Wall Street is swing, but I day trade almost every day. All right, Ahmed, let's save this question for next time. I'll think about one of the craziest trades I've ever taken. Most of them probably related to the dry shippers, VIX, or the blockchain related stocks back in December. I didn't exit when we had it last. Okay, Vineet, I think you emailed me about this if I'm correct. Maybe you didn't, but someone else did the same thing. If you've blown through your stops, one, you should never do that. And If you're doing that, I'm afraid you're going to do that again. But you need to have a stop in place and get out. Now, if you're still in it, what I would say is put a hard and fast stop. Don't get out right now. Don't get out of the worst spot. But like if the stock is at 286, place a hard and fast stop at like 267. And you have to live with it. If you take that loss, you take that loss. But you cannot let this continue to slide. Books on trading psychology, anything by Brett Steenbarger, Trading in the Zone, and Trade. It's either trade or trading mindfully. Okay, Metin has a response to the ETF question for Europeans, and that is you can trade options. So at least Metin can. All right, guys, fantastic. Great session. You guys were really active today. We'll do another one of these pretty soon. And I try to mix up the times. So, today was during market hours. We've done a few on Sundays. I'll try to do some in the evening so everyone has a chance, depending on your schedule, to attend some of these. And remember, go back and review all the videos. There's a lot of good stuff in them. All right, guys. I'll see you guys. Have a great weekend. I'll see you on Monday and then again for one of these mentoring sessions in a couple of weeks. All right. Take care.